The early part of every year is typically when people start making big life changes. Health kicks, financial audits, but the most common change people make is relationship status. January has come to be known as divorce month. When a relationship changes to the point of separations or divorce, finances are usually one of the last things people think about. But in addition to heavy impact and change to your family dynamics, separation and divorce can have long-term financial consequences. If you own property together and on our mortgages together, this can further complicate things and cause a lot of additional undue stress. For most people, they start paying attention when it's too late. They are already stressed and feeling stuck. So what I'm going to do here is walk you through what actually happens to your mortgage when you separate, what your options are. I will also walk you through the common mistakes I see people make and the assumptions they make about what happens with their lender and what they are going to be asking for. I want to help you slow things down, understand your options, and avoid making decisions where you feel rushed and not in control. So let's start breaking things down. The first thing you need to understand, just because you're separating, this doesn't mean your mortgage will automatically just change with your lender. What I mean by this is if both you and your partner or your ex are on the mortgage, then you both are still legally responsible for the mortgage payments to be made. To the lender, it doesn't matter if one person moved out because the other person said that they would handle all of the expenses, so they went out and rented another place and have a whole bunch of other expenses. It doesn't even matter if this was laid out in your separation agreement. The bank doesn't care about your separation agreement, not yet anyways. You both signed that mortgage contract, and as far as the bank and the entire financial structure is concerned, you're both still on the hook for the mortgage and the payments, even if you agreed amongst yourselves otherwise. If your ex said that they would handle the payments and then they stop paying or they can't pay for whatever reason, the responsibility still falls back onto you. And so I want to reiterate this again. When people tell me my ex is taking over the payments, okay, but legally you're still responsible if they stop paying. And you need to be clear on this. It's not an excuse that you let the payments lapse because they weren't making payments. And as a result, your credit will get impacted, and this is not an excuse. The separation agreement is between you and your ex. It's not between you and the bank. You have to work with the bank to solve your situation on paper. And the only way to actually remove someone from the mortgage and off of a property is to refinance that mortgage and make sure that the other person taking over qualifies on their own, or to pay off the mortgage completely by selling the mortgage, for example. Now, separation agreements, they're still important, don't get me wrong. They outline who keeps the house, how you split equity, support payments, all of that. And lenders are going to want to see a separation agreement, so you definitely need a proper separation agreement that is signed. But getting the separation agreement signed, that's not always easy when you're dealing with your ex. And here's the thing, in BC, a separation agreement can be legal as far as the province is concerned if it's witnessed by two independent people. So as long as you have two friends that are willing to sign as witnesses, British Columbia, the province, will look at that separation agreement as valid. However, your bank, any lenders, they will want the separation agreement notarized. They want it signed in front of a notary. And why is that? Well, because it's harder for someone to come back later on and say that they didn't understand what they signed if it was done in front of a notary. And if you drew it up yourselves without lawyers, lenders get nervous about this as well in a lot of circumstances. It's because it's easier to challenge down the road. One of the parties, if they're not happy or if they didn't get legal advice, a lawyer could come in and potentially throw that agreement out. So yes, you need the documents, and yes, they need to be done properly, but the agreement alone doesn't change your mortgage. You still have to take action with the lender. And before we move on and go through what that looks like, I want to mention an alternative to having a lawyer draw up a separation agreement. In BC, we have in most municipalities someone that is called a justice counselor. They can help you draft up a separation agreement, which you can then take to get notarized with their support, and doing it this way could save you some money. Okay, so let me show you what taking action with the lender looks like. You're going through a separation, you own a home, what are your options? You've got a few. Option one, sell the house, split the proceeds, go your separate ways. By far, the cleanest option financially. You sell, pay off the mortgage, split what's left, both of you walk away. no ongoing liability. Each of you get your share of the equity and you move forward. Downside, emotionally harder, because if you have children, they might have to move and they might have to be disrupted, their lives, their schools, and you're dealing with a sale during an already stressful time. Option 2, this is a lot more common. Someone stays in the home and buys out their ex. This is what I see the most and what people prefer to do more often. Now, there's 2 ways to do a buyout. First way is a straight refinance. This lets you bring your loan back to 80% of the value of the home. You take that money out and you pay your ex their share. Let's say that your home's worth $800,000 and you can refinance up to $640,000. That's the guidelines. If you owe $400,000 on it, you can pull out $240,000 to buy out your ex. Now, if that's not enough, there's a program that lets you go all the way down to 95% of the value of the home to pay out your ex, assuming you meet certain guidelines. So on that same $800,000 home, you could go up to $760,000. But here's the catch. You need to qualify for this on your own income alone, not joint income, just yours. Because remember, you are separating, right? So you can't use your ex's income like you did to qualify. And that's where most people hit a wall. Option 3, you can keep the house jointly for a period of time. One person could live in the house, one person could move out, and you both stay on the mortgage, maybe until the kids graduate, maybe until the market improves. Or you could even have a situation where you both agree that you're going to be spending alternate weeks at the home so that the children don't get disrupted or don't move and their regular routines don't get impacted. Either case, similar thing, you both remain, no changes, and you both stay on the mortgage and you both are responsible for the expenses and you're both making the expenses. But here's the problem. You're both still legally responsible, as I just mentioned. If the person living there in that scenario stops paying and you're not able to continue to pay, then both of your credit scores get hit. And if the person who moved out, you're trying to qualify for another property, it's going to be hard for you to do so, to qualify for another mortgage because you're still tied to this one. And you can't offset it with rental income or anything like that. So it's going to be difficult for you to qualify. So this requires also a lot of trust between you and a clear agreement about timelines as well. So those are your 3 main options. Now let me walk you through and talk about buyouts and what you actually need in order to qualify for one. So you want to keep the house and buy out your ex. Here's what lenders are looking at. Your income, just yours, not household income anymore. Your debts, credit cards, car loans, whatever you've got. Any support payments that you're paying or receiving. Your credit on its own. Now let's use real numbers. Let's say the home is worth $800,000, you owe $400,000, you've got $400,000 in equity, and you're splitting it 50-50. So now you owe your ex $200,000. So you need to refinance for $600,000 total. The original $400,000 mortgage plus $200,000 for the buyout. Can you qualify for $600,000 on your income alone? Maybe you could when you both applied together, but now it's just you. I see people commit to keeping the house in their separation agreement before they talk to anyone about whether they can actually qualify. Then they're stuck and they can't get the refinance and they can't move forward. And this is the biggest source of confusion because that spousal buyout program, many people I've heard say that the government will allow you an exception, and they do, but the exception is to be able to borrow more. You still have to qualify. This is a missing piece that can cause people a lot of confusion and a lot of headache. My biggest recommendation is talk to a mortgage specialist before you finalize that separation agreement, not after. Run the numbers, know what you can actually afford, because just because you can technically qualify doesn't mean that you should either. I've had clients who could keep the house, but then they'd be completely house poor. Every dollar going to the mortgage, no room for life. And that's not sustainable. Now let me talk about support payments because this can have a huge impact on the buyout situation as well. And also with respect to your income levels. If you're going through or have gone through a separation and you're applying for a mortgage, 9 times out of 10, your lender is going to ask for a separation agreement. Are there exceptions when you can't provide one? Yes, there are, but don't rely on that, especially if there are children involved and there are support payments and there's property involved as well. lenders will usually want to have a separation agreement. And there are two types of support. There's child support and spousal support. If you are paying support, it has to be included in your debt payments. Lenders treat it like any other debt. You're paying $2,000 a month in child support. That's $2,000 a month that can't go towards your mortgage. It reduces how much you can borrow. Now, if you're receiving support, we can add that as income to help your application, but only if it's court ordered or in a signed separation agreement. You need to prove that this is being paid consistently as well. Some lenders will require a 3 to 6 month history of bank statements showing that you're getting the payments. And most lenders, they are starting to look at perhaps only allowing a portion of this. It depends on the lender. And the reason for this is support payments can stop. They're less stable than employment income. And also, if you've got child support, for instance, there could be a cap on when that expires. When the child turns 18, for example, and let's say that they're going to turn that age in the middle of your mortgage term, right? So for these reasons, don't assume that you're going to be able to use 100% of all the payments. Some lenders have caps for the age of the children as well when it comes to support payments as well. And if you and your ex just have an informal agreement, you're e-transferring money, but there's no formal agreement, that's going to be difficult to be able to count as well. It needs to be official. Lenders need the paper trail. So documentation matters, and it matters a lot when it comes to support payments. Now, let me show you the mistake that people make. Here's where people get hurt. Mistake 1, moving too fast. You sign a separation agreement saying you're keeping the house before you know if you can qualify for the refinance. Now you're committed to something that you can't actually do. You're stuck. Your ex is stuck. Talk to someone first, run the numbers, then make the decision. Mistake 2, assuming you can afford what you qualified for before. You and your ex qualified for $500,000 together doesn't mean you can qualify for $500,000 on your own. Your income is different. Your debt might be different. Support payments are in the mix now. Don't assume, run the actual numbers. Mistake 3, not getting documents done properly. You need separation agreements signed, and I get it, it's not easy when you're dealing with your ex, but trying to move forward without proper documentation is worse. Lenders want notarized agreements, not just witnessed, notarized. This is the safe bet and best practices. If you draw it up yourselves without lawyers, lenders are going to look at it more closely as well. As I mentioned earlier, there is the option of a justice counselor, and they're very affordable, and I think in a lot of cases are free as well. So you definitely want to look into that. Now, I've seen people try to refinance with agreements that were signed but not notarized, and the lender wouldn't accept it. The whole thing stalled out. So get it done right the first time. Mistake 4, not understanding the timeline. People ask me, should I refinance right away or wait? The complete answer really is it depends. Refinance too soon before your separation agreement is completed and done and agreed upon, before support is established, and you might not have the documentation that the lenders need. If you wait too long, you're carrying risk. Your ex could be missing payments. Your credit takes a hit. There's no perfect answer. It depends on your situation. And honestly, if you're able to set your differences aside, it'll be a lot smoother. But again, with emotions involved, it's very dicey. And honestly, this part, there's no black and white. It really does depend. Now, here's what you need to know about getting this done properly. So here's the reality. You're going through a separation, you want to keep the house, or you're trying to figure out what to do. Here's what you need. Step 1, get a lawyer. I'm not a lawyer. This isn't legal advice, but you need someone who knows family law to help you with the separation agreement. Step 2, talk to a mortgage broker before you finalize anything. Find out what you can qualify for, what your options are, what documentation you need. Don't commit to keeping the house until you know that you can actually do it. Step 3, get your documents notarized. Don't cut corners on this. Witnessed isn't enough for a lot of lenders, so get it notarized. It's worth the money that it will cost you in the long run. Step 4, understand the full picture. It's not just about whether you can qualify, it's about whether you should. Can you handle the payments on your own? What happens if your income changes? What if rates go up at renewal? Think beyond just getting approved and the short term. Step 5, have a backup plan. What if you can't qualify for the buyout? What if your ex won't cooperate? What if the market changes? Know what plan B looks like before you need it. This process isn't easy, it's emotional, it's stressful, but understanding what's actually possible with your mortgage, that makes better decisions possible. Look, divorce is hard. I'm not here to tell you what to do with your life. I'm here to show you what's actually possible with your mortgage and the steps around that so you can make informed decisions. Whether that's buying out your ex, selling and moving on, or something else. Get the right people in your corner. Lawyer, mortgage broker, whoever else you need. Understand your options before emotions and time pressure force your hand. If you've got questions about your specific situation, drop me a note in the comments. Reach out. I'll got my direct contact information in the description, and I'm here to help. Thank you for watching.